Welcome to the Future of Education. And now, here's your host, Michael Horn.
Welcome to the Future of Education. I'm Michael Horn, and you're joining the show where we're dedicated to creating a world in which all individuals can build their passions, fulfill their potential, and live lives of purpose. And part of that equation is thinking about how we pay for and afford what's become a more and more costly higher education over time. So to help us learn about and think through some new research about what was a very interesting program to make higher education not just more affordable and accessible, but also focused on real value, in my view, are two individuals that we get to welcome today. First, we have Ethan Pollack. He's the senior director in the policy and advocacy practice at Jobs for the Future, or JFF, as it's commonly known, where he leads the Financing the Future initiative, which explores these new approaches to financing post-secondary education. So, Ethan, great to see you.
Great to be here.
Yeah, you bet. And Kevin, we have Kevin Mumford, who's an economics professor at Purdue University, also the director of the research center in economics at Purdue. Kevin, great to see you, and thanks for being here.
Yeah, thank you. Happy to be here.
Yeah, so we're going to get into a bunch of things in a moment, but I wanted to sort of level set us, start with the basics, because we're going to talk a lot about income share agreements today, ISAs as they're known. And we're going to talk specifically about a program that was in effect at Purdue, the Back a Boiler ISA program, and a working paper that you published, Kevin, recently. But before we get into all that, I just want to make sure our audience is level set. We're all on the same page. We know what we're talking about. I know how I describe an ISA, and I see it as a pretty compelling alternative to a loan, at least on paper, for a given individual. But Ethan, you've thought about this much more than I have. You probably have a much more concise answer. So in brief, tell us, what is an ISA?
Sure. So an ISA is, I think, best defined in contrast to what is more the standard, in particular the standard in the private loan space, where in that latter space, you really have fixed payment loans, right? You have much more kind of like a mortgage. You're paying a fixed dollar amount over a period of time. You have to pay back at the end of the loan. You need to pay back the principal and then the interest. And ISA is different in a number of respects, but the main respect is that it is income based, that you are paying on the basis of how much you earn. So students are only making monthly payments if they earn at least a certain income threshold. They're also making payments that are a percentage of their earnings. So if they earn above that threshold, they may pay a certain percentage. It can be anywhere from a couple percentage points. Some of the short-term boot camps were charging pretty high income shares, up to like 17 percentage points. Purdue's are much lower. And then the last feature of an income share agreement that's unique is that it expires after a period of time. So it's really de-emphasizing this idea that you've borrowed a certain amount of money and you need to repay it with principal and interest, and actually operates almost a little more like an equity investment, where you're paying on the basis of how well you do. And the person that, the entity that gave you that kind of, financing, that ISA, is going to be, receive a lot more revenue if you do well after graduation. And they're going to then receive a lot less. And they may receive nothing at all if you never earn above that earnings threshold.
So a couple key things then that stand out about that, right? It changes it from paying based on the cost or the expense to paying on the value, if you will, of it. And then there's some more risk, obviously, on the part of the institution as a part of that, it seems. Kevin, then, ISA programs, they look different in different places. Ethan just alluded to that. They have different incentives and so forth. Tell us a little bit about the origins of Purdue's spin on this through the Back a Boiler program and its specific mechanics as well.
Sure. It came about because of the president we had at Purdue at the time, Mitch Daniels. He had been asked in the spring of 2015 to testify before a House subcommittee. And in that testimony, he had kind of a throwaway line about, wouldn't it be great if the university was doing something with income share agreements? And he got so much sort of press inquiry after that he started thinking to himself a few weeks later, maybe we should really do this. There's so much interest in it. So there was this funny episode where he calls in the head of the foundation and the chief legal officer for the university, the chief lawyer for the university, and says, let's start an income share agreement. And they both were like, yeah, let's do that. And they left the office and then turned to each other and said, what is an income share agreement? And they Googled it on their phone. And the university just kind of, he started the apparatus. 12 months later, they started accepting applications and they launched the thing. The idea was they're going to allow it to be available to all majors. And in some majors, people earn a lot more, and in some majors, they earn a lot less. So they tried to price it according to what they thought the earnings would be in that major. They put all the majors into 7 different bins and said, if you're in this kind of high earning bin, then we're going to charge a lower income share rate. And if you're in a lower income bin, we're going to charge a higher rate. And the idea is to try to make it so that it would compete well with a Parent Plus loan. They weren't going to try to compete with the subsidized federal loan or the unsubsidized federal, the direct federal loans, but they were going to try to compete with the Parent Plus because it has a higher interest rate. And the difference here would be is that a Parent Plus loan, the parents are the borrowers. Here, it's the student who is taking on this repayment obligation. And, there were some protections, like Ethan said. There's a lower threshold. There's an upper bound. Nobody could pay more than, originally it was 2.5 times the funding amount. Then it went to 2.3 times the funding amount. So that's kind of the basic idea, though. Price it so that people would be paying back about what they would under a Parent Plus loan.
Super interesting. I actually didn't know that origin story. I knew it would come up with, that's hysterical. I did not know that piece of it. And then put it in context of when this launched, right? Why was it such a big deal at the time? How did it fit in right with the larger movement? ISAs were gaining a lot of currency as an idea that might be this alternative to loans. Give us a sense of why this was such an important program.
Yeah, it was a really interesting time. So I was at the Aspen Institute at the time, and I remember hearing about income share agreements and both thinking wow, this could be really exciting. This could totally kind of rewire, how we do, higher ed finance and workforce as well outside of the Title IV system. And also is this could also be kind of dangerous too, right? We don't have, guardrails that are uniquely designed for income share agreements too. And there's a lot of uncertainty as to which laws actually applied to ISAs. And so I was kind of in this middle camp of being really excited about the potential. But also then having a bit of concern. But there was at this time, when it was launched in 2016, there was this real interest in ISAs, not just in higher education, but in particular, this was also the rise of kind of the time of coding boot camps. And with coding boot camps, there a lot of the tech companies were feeling, look, you don't need a college degree. We can just teach you to code, and we know that you don't believe us. So instead, we're going to take on the risk and attend our coding boot camp. And if you don't make above a certain amount, then you just don't pay anything back. So I think that that was happening in tandem then with the Purdue program. But overall, there was this really, especially when Purdue launched, there was this kind of real kind of boomlet and media excitement around income share agreements. But then there was also this backlash, right? And the backlash had a couple different facets, which happy to get into, but I'll gloss over it right now. Is just to say that there was some concerns around consumer protection, and there's some concerns around that this, like any type of financing product, could be used in predatory ways. I think that most of the the actors in the space at that time were trying to do the right thing. And I worked with many of those and thinking about kind of where are good best practices. But there were some bad actors too, right? I mean, whenever you're kind of introducing kind of a new product, there's going to be either bad actors or people who just are not fully understanding how this tool can be used. And so I think that there was a real push towards using income contingent financing, but it was done very quickly, and I think that as what I lament is then the energy was really towards income share agreements for a while, and then a few years later, kind of was oh, I guess that didn't work, and so it kind of flamed out very quickly, And, this was kind of the origin of my partnership with Kevin, was this feeling of like, I don't think we ever fully studied this to see whether it actually worked or not. And everyone else just kind of moved on to the next shiny thing. And here we were saying like, oh, we got a lot of data. We should actually look at whether this worked or not.
Well, so I want to get to that in a moment. And you mentioned the controversy. We'll come back to that in a moment as well. But sort of tangentially related, I think a lot of people think that the program ended because of a lot of the concerns around ISAs and so forth. Kevin and then Ethan, both of you chime in on this one. Why did back a boiler? Why did the program pause? What led to that? Kevin, why don't you jump in first?
Well, I mean, the most basic reason is that the university set this up very quickly by going with the service provider. So the service provider had been the one originating all the contracts. And in 2022, the service provider shut down and sold the existing contracts to another provider, but one that wasn't able to, or doesn't have a business of issuing new contracts. So the university was in a situation where they said, well, we're not sure how to issue new contracts, but we'll continue to service the contracts we have. And I think that happening like right at the same time as when the president of the university was stepping down. The new president wasn't opposed to this, but this was also not a champion of an income share agreement. And so the university would have had to, find some other provider or set up the ability to do it on their own. And they just haven't put in the effort to do that. I mean, I think part of it also was kind of because of the pandemic, and it's because the university received a large amount of federal funding and to provide directly to students. And the students that we've been advertising, or I guess you can't advertise, but we've been offering this income share agreement to, they were the students who had already maxed out their federal borrowing. And that's exactly who they decided to subsidize with the federal funds from the pandemic relief. And so there wasn't a lot of demand for it right at that moment as well. And it kind of just contributed to saying, maybe let's not issue new contracts. Although if they were to revisit the decision today, that might be different. I also think a factor is the regulatory environment. There's still just been an uncertain regulatory environment, which makes entering difficult.
Ethan, what would you add in there? Yeah, I was going to say, Ethan, what would you add to that last point? Because you're very deep into this regulatory questions around the status and the legality of ISAs and how they're governed.
Yeah. So ironically, the same year that Purdue paused was also the year that CFPB signed a consent order with Better Future Forward, which is a nonprofit ISA provider, mainly works with college access programs. And the consent order is they fined Better Future Forward $0 and thanked them for working with them. It took them BFF and CFPB a full year to figure out what is the disclosure for the Truth in Lending Act. It was just focused on TILA. And so actually, right around the time that Purdue paused was the same time that BFF published this disclosure template. That they said like anyone can use this, but the bureau has actually signed off on this as like a way to comply with TILA. So that was a moment when there was starting to become more clarity. Since then, also California, Colorado have done rulemaking on their own state basis to improve the regulatory clarity. And then Illinois actually just a few weeks ago, Governor Pritzker signed legislation to kind of improve the regulatory clarity. But the main issue here is that, and what Purdue was really facing was that, the rules governing these credit products were largely designed with fixed payment structures in mind. So you think of something like the Truth in Lending Act. You need to disclose the APR, the annual percentage rate, when you're presenting the loan or the credit product to the student. With an income share agreement, or even with something like an outcomes-based loan, because these can be structured still within a loan framework. The federal IDR program is a really good example of kind of an outcomes-based loan, right? It's a loan, but at the same time, you're going to be paying on the basis of your earnings. But if you have a product like that, what is the APR? Well, it depends on how much you earn after graduation. So it's really hard to know that when you're first presenting this to a student, to a borrower. So that's just one of the many ways in which the existing regulatory framework was really kind of poorly suited and created a lot of uncertainty. I think that in this uncertainty, there was then also some criticism. So a lot of ISA providers were basically recognizing that it's like, look, we're not sure how to disclose APR. We're getting no guidance. We also feel like there's a legal, there's some legal basis for us saying that we're just not subject to the Truth in Lending Act because we're not credit. We're more like equity. We don't have principal. We don't have interest. We're just structured in a very different way. That I think a lot of the consumer protection advocates got really freaked out by that, because the precedent that there was a what they saw as a credit product that was financing education, that somehow you could kind of avoid complying with all of the existing kind of consumer protection laws, not all of them, but many of them specifically designed for student loans. They thought that is just I saw that as a real threat, and I understand why they felt that way. But it really was just this regulatory uncertainty that was the underlying problem. They also had some concerns around things like what you might call kind of differential pricing, or the underwriting. And so basically, if you are charging lower income shares in the contract to fields of study, either majors or graduate programs that have higher earnings, you could create some disparate impact. There was a concern around that too. Again, this was all just theoretical. And then there was also, then once Purdue had started, there were some examples of students that ended up paying more than they otherwise would have under Parent Plus. Now, we could guess why that was the case, because they were earning a lot more than the average student. But nonetheless, there was a lot of stories and kind of newspaper and coverage around these specific students who really felt like, I feel like I overpaid. And so I think that was also kind of part of, as Purdue was pausing, I think that was the broader kind of, I would say, media context in which kind of that decision was made. I can't speak to, exactly to what extent that was taken into account, but it certainly was something that was prevalent and certainly didn't help the case for trying to really kind of continue this program.
Well, so I want to dig into the research in just a moment, but quickly, Ethan, just on that, because, Kevin, essentially what you're describing, again, is consistent with what you said up front, which is it's really a last dollar program, if you will, of financial aid, right? It's not the first dollar competing against federal subsidized loans. And so that had something to do with the crowding out, if you will, from the federal funds that came in at the time. The second thing, though, Ethan, you talked about the regulatory uncertainty at the time. You talked about how it's starting to resolve a little bit. Give us to the extent you're able, give us sort of the quick snapshot of where do these vehicles, if they were to sort of make a comeback in the limelight, where would they live at the moment? Because this sort of lending classification has always felt kind of weird around this.
Yeah. So there's a movement towards, I would say, momentum towards resolving the question of are ISAs loans to resolving it in the direction of they are loans, but they're a unique type of loan. And so, that kind of solves everyone's problem. Where there's no claim that this is something that's separate, but at the same time that so for, a good example is the Bureau's consent agreement with Better Future Forward, where or the compliance plan, where they said you're a loan, but also they developed a very unique compliance plan for Better Future Forward, taking into account that it didn't have any interest. And in fact, there are certain boxes in the TILA template that says that the interest can range from and there's two boxes from X to Y, and the Bureau ordered BFF to just put in NA into both of those boxes.
Oh, interesting.
Which if you're a lender, you can't do, but it was a recognition that it's you're not a normal lender. This is a unique type of product. California and Colorado, when they did their rulemaking, also reflected these are loans, but these are a unique type of loans that deserve a specific type of treatment. And then the Illinois legislation that just very recently passed also treats these as loans, but unique types of loans. So I think that's kind of the regulatory direction that we're going on.
Gotcha. I can't decide if NA is better than 0 to 0, but either
they're not at all confusing to students.
Right. Exactly. So, okay. So now you have this research paper, Kevin, that comes out. We'll link to it in the show notes. The working paper title is distribution of returns to a college income share agreement, evidence from administrative data. So this is actual evidence of the outcomes. First, give us the origin story. How did the paper come about, and what's JFF's connection to it? Kevin, why don't you lead us off, and then Ethan, supplement anything that should be supplemented.
Sure. Well, I was actually away on a sabbatical when this program launched, and I was focused on other research. When I'd gotten back, I read about it and thought this seems interesting. So I contacted, the group at the university working on it and just said, "Who is doing your internal evaluation? Like, I'm really interested to see." And they said, "Man, we set this up so quickly, we didn't even think about that. Nobody's studying it at all." And so I said, "Well, could I see the data?" And they said, "Sure." And they just sent it over to me. And so I thought, hey, this is great. In 2022, I had a paper that was about selection into the program. What kind of a student is selecting in versus not? And it's aimed at a small number of students. There's not very many that qualify because very few Purdue students actually hit the federal borrowing limits for those subsidized and unsubsidized direct federal loans. So there's not very many students who even could consider it. But I got data for all the students who were shown the terms that they saw. This is what the income share rate would be for me, and then saw which ones decided to take it up and which ones didn't, and then looked at why some were doing it and some were not. That paper, I don't know. 2022 is right at the time when nobody's interested in income share agreements anymore, and so it's still under review, but it hasn't been one of these things that everybody seems super interested in. And so Ethan contacted me recently and said, I think maybe there's a moment, maybe people are interested in ISAs again. And don't you still have all that data? And yeah, I mean, there's still a lot of data, particularly in that first paper, there was nothing on who was paying back, what kinds of payments were we receiving. And he just said, I really think people would be interested to see, how did this program do financially? I mean, did the university make a ton of money off of these students, or did they lose a lot of money on these students? And, were there students paying back way more or way less than what you would anticipate from a private loan or a federal loan? And he just thought that people would be interested now. And so I'm always interested in doing research that people are interested in reading. And he kind of convinced me it was worth putting in some effort for a bit on this project as opposed to all the other projects I could have been working on.
Perfect. Yeah. Ethan, what would you add, and perhaps also with an eye toward why the research is relevant now in your view?
Yeah. Well, I'll start off with that. There's so many things happening that I think make this research, not just this research, but the Purdue ISA program. That if it hadn't launched 10 years ago, I think people would be thinking now, man, we should try to do something like this. So the reason is, I think a fewfold. So one, institutions are facing demographic cliffs, right? So the number of traditional college students can be declining about 10% over the next 2 decades. They're going to have a huge drop off in international students too. That can really put institutions in a tough spot. I know you've covered a lot of this in your podcast with Jeff. So, listeners of both won't be surprised by any of this. And then of course from the big, beautiful bill, a lot of the borrowing limits are going to have really big impact. So I published this, an analysis last week, on JFF's website. It found 1 in 10 students are going to be impacted by the caps. And they're going to be forced to either forego education entirely or go to the private lending market. The private lending market has some really you can get some cheap credit, but oftentimes for many students it's going to be more expensive. More importantly, it's going to 95% of private loans require cosigners. They all do credit checks, require a certain credit score. And then in addition to that, it doesn't have any type of the low wage borrower flexibility that the federal IDR program has, or that ISA programs have, which is that, if you become unemployed or you end up having a lot lower income than you thought that you're going to, that you'll pay less and you might pay nothing, right? But with private loans, with some very rare exceptions, nearly all private loans, you got to pay regardless of what's going on with you, right? And they may do some deferments, on a case-by-case basis, but that's not really kind of baked into the contract, right? So it's not a really firm protection. And so, we're at this moment where it's wow, we're going to have so many students that are going to be going into the private lending market. What types of products are they going to get? Don't we want them to have types of products that are kind of like ISAs? that are kind of like actually the federal IDR program that have these types of low wage protections. And in particular are also more accessible too, because we know there's going to be a lot of students that may just not qualify for private loans because they don't have a cosigner, because they have bad credit. And ISAs are in particular forward-looking as opposed to backwards, right? They care less about where you've been and more about where you're going. What's the program you're enrolled in? What are the outcomes? And so the Purdue program, for example, it didn't require a cosigner. That was like really important to the model, right? So for students that could not access Parent Plus, then they could access something like this, right? So I felt like this is such an important moment, and like we also, instead of setting up a pilot and then studying it taking 10 years, like we just kind of took a time machine, created the program that's most relevant to today, and then now we've got all the data, which is kind of a researcher's dream. And so, Kevin and I had talked before, but I kind of view it as like, we've got to get some data out here. Like I think that people would be really interested in this. And it feels like this Purdue ISA program is now more relevant than ever, both for policymakers, for institutions, for philanthropy, and then for researchers such as myself. And in particular, it had gotten, for the criticism, I was really interested to test the criticism, because a lot of the criticism and a lot of the claims too, it was all based on speculation, right? We didn't actually have the research. And I don't like kind of making claims without a lot of rigorous research. And so now we had enough data, and I wanted to see, like, was there any disparate impact? Maybe there was. Like, this would be really good to know. Like, how affordable was it compared to Parent Plus? And so these were the types of things that Kevin and I were then able to, figure out. So I think that Kevin was very much, the primary researcher, and I was the one that was kind of enmeshed in the broader discourse, unknowing kind of like, this is what people would be interested in. This is how it could, your research kind of connect back to kind of like, to actually be relevant.
And so, Kevin, I want to start to get into what you found then in the report itself. It occurs to me it's like an interesting sample of time, because you both have some really hard economic times with a lot of job switching in those sample years. You have some boom times in there. So it's like it's a very interesting set of years that I suspect you're following these students. But talk a little bit about what you were looking for, the methodology, and then the findings itself.
Well, the basic methodology is to look at the stream of payments coming in from those students that are participating in this program to see how much are they paying back, and then you need something to compare it to. So, what I do is I take a traditional student loan and I peg the interest rate to be the same as the Parent Plus loan, and say, what would a student have paid back had they been paying back a traditional student loan at that interest rate? And just do the comparison to see, are they paying back a lot more or a lot less than they would have otherwise? And I think the time period you bring up is relevant because there's job switching, job loss, there's uncertainty. The thing about the income share agreement is that when your income goes down, your payments go down, and when your income goes up, your payments go up. I mean, it's adjusting to the economic conditions automatically, and adjusting to your specific characteristics. Because if you lose your job and you're unemployed for a period of time because of the pandemic or because of any reason, then the payments stop until you start working again, and that's just sort of built in already. So some of the results might be colored by that. I mean, if this was sort of the best booming economic times ever, payments probably would have been higher than what we've actually observed. But what we observed is what happened, and there's some movement up and down in people's careers. The data comes in, and I actually do it two ways, because there's a lot of ways to pause payments in this income share agreement. Again, if you're unemployed, you're not making payments. And there are protections in student loans. They're maybe not as generous as an income share agreement, but so one way I do it is I assume in the student loan that you just make every single payment as scheduled all the way through. And the other assumption is that anytime you pause your income share agreement, you would have also paused your student loan. And the truth is probably somewhere in between. And I compare the amount each student has paid and then the amount the university has received. And the amount the university has received is right around that same amount that they would have gotten if it was a Parent Plus. It's a little bit less than that, which suggests that maybe they're getting a sort of a less than a 6% internal return. On the other hand, income share agreement payments grow over time because they increase as the student's income increases, and it naturally goes up over time. So probably the university's best payment years are still to come, and they're not these initial beginning years. So it may be that the internal rate of return is a little bit higher by the time it's all done, but it doesn't look like the university made a lot of money. If anything, they probably would have done better just investing in the market. On the other hand, for individual students, the average student paid less in the income share agreement than they would have if they had gotten the traditional student loan at the Parent Plus rate. But there are a handful of students at the top that paid back much more. So some students hit the cap. They pay back 2.3 or 2.5 times the amount that was originally funded. So some students are paying back a lot more, and that's because those students have very good jobs and are earning really high incomes. There's a lot of students that are paying back a lot less, much less than they would have, and that must be because they've decided to stay at home for a while. They've decided to do they're stopping out of the workforce for whatever reason, and then you just don't make payments while that's happening. The average student, is paying a little bit less than they would have under the Parent Plus. They're doing a little bit better, and that reflects sort of the slightly lower rate of return that the university is getting on a whole.
Super interesting. Ethan, before you jump in with some of your takes, one other question that I'm just curious about, Kevin. What was the impact on Black and Hispanic students and underrepresented students? Because that was a big question that a lot of the consumer protection advocates were raising it. And maybe you pull in some of your 2022 research on this too, because if I'm recalling correctly, one of the speculations also was that some of these students, what Ethan just said, that it's forward-looking, not backward-looking, true in theory, but maybe you would select out, right, certain students that come from lesser advantage or less academically prepared or whatever it might be. And so perhaps they wouldn't actually get to benefit from the protections that an ISA brings to the table. What have you found on all that?
Well, I think we're right to be concerned because it turns out this program has disproportionate numbers of Black and Hispanic students in it. And that's probably because those are the students who are maxing out their federal borrowing. And so it is serving more minority students than the traditional student loan program is serving at Purdue. That said, in terms of the ISA repayment, those students tend to be getting a better deal, not a worse deal. That is, just as we look at the stream of payments coming in, they seem to be paying back even more or less, right? Like even less than they would have under the Parent Plus program, in comparison to the white student that is a participant. And so I think that we should be concerned about it because these programs are serving more minority students, but at the same time, it seems to be offering them a better option, a better deal on average than it is for the equivalent white student. And that's really not because there's anything special that's race or ethnicity focused about the program. It just has to do with what the earnings look like afterwards. And because the earnings for the Black and Hispanic students are a little bit lower than those of the traditional white student in the same program, that's why they're paying back less in this.
Super interesting. Okay, Ethan, I'm curious your takes. Yeah.
Yeah, I was just going to add to that. I mean, this was always the concern, as Kevin said, I think really well, the concern around disparate impact was very valid. Whether it's an income share agreement or even if it was just a loan. Like any type of financing product, this is why we have the Equal Credit Opportunity Act, right? It, is to make sure we know the history of redlining and reverse redlining, and that with an income share agreement, it creates new potential opportunities to be violating fair lending laws and to be exacerbating racial gaps. It is also the case that income share agreements can do the opposite and can actually, if designed well, can be more affordable. And so it was always this thing that, when the Purdue program was being criticized for this, I felt like a lot of the critics were voicing valid concerns, but they were drastically overstating their confidence in it, where they were saying that the Purdue program is discriminating, or the Purdue program, or that ISAs, I remember hearing from some consumer advocates that ISAs are inherently discriminatory. And again, it was all theory-based. right? And so, I kind of responded to that in 2022, published some research that we got the proprietary data from Leaf, which is it no longer, but was a servicer mainly of tech boot camps. And we did a disparate impact analysis that used the same methodology that CFPB uses when they're figuring out disparate impact. And we found that there's no evidence that there was any type of disparate impact here on racial or gender lines. But even still, like it's the frustration is kind of like, yeah, you should be concerned, but like we don't know until we actually crunch the numbers. And a lot of the critics just weren't doing, they did, and partly they just didn't have the internal data, right? But it should have been voiced as a concern rather than a conclusion. And so this is why, kind of, on the one hand, whenever we have concerns, we should voice that, we should recognize the information we don't have, right? And recognize that, we can have a concern without saying that this is bad. We need to wait for the research to come in, but then also we need to make sure that research is actually funded and, it is prioritized, and then do the research, and then you kind of update your priors. And so, like, it's really exciting that now we have enough data to be able to say, at least for now, it doesn't seem like there was any type of, of disparate impact at all. In fact, certainly for Hispanic students, were far more likely than white students to be in the having paid less than having paid more than Parent Plus. And this comes on the heels also of Kevin's 2022 research, which found that, it looked at the impact of the ISA program on completion rates, and found that overall completion rates were boosted by about 3 percentage points. But that was significant. It was 6 percentage points for Black students and 17 percentage points for Hispanic students. I think that the Black student one may not have been statistically significant. Kevin, you might remember that better. But the Hispanic one was definitely 17 percentage points is huge. So, this is a program that also is, clearly benefiting students, in terms of the completion, is also more affordable, and in particular more affordable for racial minorities, and then also is more accessible too. And we know, in particular for Black and Hispanic students, they're going to be less likely to have either a good credit score or have available parental cosigners.
I just want to jump in, because when you say that 17 percentage points, it makes it sound like it's unbelievably large. But you got to remember that these students are the most at risk at dropping out. So these are students who, this isn't about access to the university. This is, they're a junior or a senior who has now run out of borrowing ability. They can no longer get federal loans. They've come to the financial aid office saying, I'm not sure what to do here. And you think, a student might come in and say, I'm thinking of a Parent Plus, I'm thinking of this ISA, I'm trying to make the decision. But what about the student that says, I don't have a parent cosigner, I don't have a parent that'll do the Parent Plus? The private market, private student lending market, they want parent cosigners as well. I don't have anyone backing me. So it's either drop out and go get a job for a semester and then try to come back, or it's do this ISA. And it turns out the ISA is really, really effective at helping students stay in school. And so even though the university is not making money, I guess you could say they're kind of losing money on this program because they're not making what they would make by just putting the money under my arrow.
Sure.
But they're getting a huge return in terms of students completing, students graduating. And that's where the pressure is. I think of this as a really cheap way to help marginal students complete. Universities should be thinking of this not as an innovative finance thing or we're going to make a lot of money off this. The Purdue experience suggests universities are not going to make a lot of money off ISAs. But if a university gets into it, the advantage is you're helping a marginal student stay in school as opposed to dropping out to try to get some funding to pay their tuition.
Well, so even with the federal loans, with this kind of these new borrowing caps that are now in place, that's going to be even a bigger problem for institutions.
Well, I was going to say it probably becomes more important, right, to have these alternative vehicles out there in certain cases. Otherwise, completion rates could plummet at the sort of the last mile, if you will, as you're rounding the corner. As we start to wrap up here, I want to think about or hear your big lessons and takeaways and sort of where we go from here with this research out there. One of them that occurs to me is the importance of the design of these programs, and maybe even like who is backing the finance, right? Like the fact, Kevin, that you kept saying these are Purdue's dollars, it seems like, right, that are part of the program as opposed to an investor, perhaps could be an important component as well. But I'd love your wave the magic wand, what would you see done based on this research? What are the big highlights, takeaways, lessons that we should be thinking about?
I just want to say something. I'll let Ethan take the big picture. But one thing is the university dispersed $20.8 million to these undergraduate ISA participants. And some of that money did come from some investors, but the investors tend to be sort of philanthropically motivated. These were foundations that were trying to see this thing started. They were also not expecting a big return on their money. In terms of investors getting involved, I have a hard time seeing that there's a huge play for this Purdue type of program because the return on investment at this price point was just not very large. What I see is universities putting their own resources into it seems to make a ton of sense because they could be putting it into sort of, scholarship programs or expensive programs to try to keep kids in school. And instead, you could just provide this type of funding and they're going to get their money back. That's the idea. I mean, I would love to see more universities try this.
Well, it seems like a great way to, like an evergreen, if you will, fund that replenishes, even if it isn't, to your point, as much as you could be earning. If you at least, make back inflation or something like that, that might be worth it, right? At the end of the day.
Yeah, that's exactly right. But, in terms of big vision, maybe Ethan's got more of a big vision.
Well, so Ethan, what last word as we wrap up here? Big lessons, takeaways, magic wand you would like to wave and see done with this? Other questions we should be asking?
Yeah. So, first to add to what Kevin said, I do think that, not only institutions, could put their own money behind it, but I do think that this can be a real good philanthropic play as well. So for philanthropies, in particular, impact investors who may be able to take less than market rate returns. I think the ROI, if you're talking about a, kind of a social impact ROI, which they're going to be much more attenuated to, like that can be really huge because, this is something that can be an evergreen fund. And so they're able to kind of get their money back, but at the same time, they're able to drive real impacts for students. And that's something that I think that, in particular, impact investors are always looking for those types of opportunities. And this seems like this is a perfect one for that. More broadly, I think, one of my lessons is that, and I don't mean this as a criticism of Purdue at all, but I really love Kevin's, Kevin talking about how he started getting involved in this, is that the research wasn't baked in from the beginning. And I think that that's something that's not super unique. I think that I've seen so many either ISA or outcomes-based loan programs that are all trying to do this type of kind of, pay it forward model. That oftentimes the research is not at the forefront, or maybe they start the program and then they're like, okay, maybe now we'll find a researcher. And I know, as Kevin has talked about, if he had been tapped in from day one, he could have designed some more natural experiments to really get some really cool quasi-experimental design. And he does do some quasi-experimental design, but it was a little more happenstance. And to be able to kind of bake that into the beginning and do some randomization can lead to some really interesting results. And, I think that oftentimes there's a lot of people have really cool ideas that are really trying to build something new, and they get really excited about starting to build. But I think what they forget is that if they're really trying to drive impact, they need to recognize that the way you drive impact is by doing the thing and then having some really rigorous research that shows that it worked, or that shows the ways in which it didn't work, so that the next person who wants to build something is able to learn from what you did. And otherwise, what we have is all of these, people that are inspired doing kind of cool stuff, but it all kind of just like dissipates because they do it and then they know that they did it, but it wasn't able to really scale up. And so it's really just like a plea for more research from, on the front end. And then for us, Kevin and I would also like to do more research on the Purdue program. There's so many more research questions that we want to get into too as well. Also, is any philanthropic funders who are out there that want to second and third phase of our work? We are available and happy to talk about all of the additional questions. We have this huge data set. They already did the work, and all we need to do is we just want, we can spend some more time to really answer some really interesting questions there.
Terrific. I love that you guys have invested in that side. It feels like it's a lesson in, I'm going to call it a lesson in evergreen iteration. Because sometimes out of research, we want the headline, did it work or did it not work? As opposed to, okay, what are the lessons learned? How do we keep improving right from there so that the impact over time is actually there? It's not always convenient, I suppose, for the headlines, but it's perhaps better for students. So Kevin, Ethan, huge thanks for coming on here, talking about it. Huge thanks for doing the research, writing it up. You can also check out, Ethan, you had a blog, I believe, on the topic headline, Promising New Insights from Purdue University's ISA program. So check that out as well. We'll also link to it. And for all you tuning in, we'll be back next time on the Future of Education.